So you guys have asked about my opinion on DocuSign, down over 52% year to date and down over 20% today alone to $75 a share. And I remember many people were trying to buy the dip whenever it actually went down around 140. Why? Because the CEO was buying shares back then, and the rule is that if the CEO, which knows the company more than you do, if he's buying at 130, it means that he is saying that it's a cheap price. But sometimes even the CEO can be wrong, and this is a perfect example. Now the stock is sitting at $75 a share, and the main reason for the stock going down so much, which it fell around 20%, it was mostly because lower guidance than expected for fiscal 2023, as growth is slowing much more. Of course, after we came out of the pandemic, many people use DocuSigns and those other services to kind of do e-signing and things online, and there was much more businesses and stuff signing up for this product there right now, because many people now can just go back and then just sign in person instead of the business or the company trying to pay for a service like DocuSign. So in this video, we're gonna look at it a little bit more, see my valuation model on it, and see if this is the real buy the dip opportunity, because there was many dips on the stock. Is it this one, or if we should wait a little bit more? As you could see here, they were massively growing revenues, and over 97% of their entire revenue is actually subscription-based recurring revenue, which is something I really like, because it's high margin and it's very predictable. They also, grew customers a lot. I mean, it's a pretty nice business, over 119% net dollar retention, more than 100%, 119%. It's pretty amazing. Now it's been going down, which is not a good sign. This trend should not really continue. I hope it doesn't continue. But even 119%, it's still pretty amazing for this kind of company. They're also trying to invest internationally to kind of expand their growth and their TAM. Now, not many documents here in the United States are signed up kind of on DocuSign and signed online, but much less are actually signed around the globe, around, in Asia, in Europe, in emerging markets, and over 55% international revenue growth they actually experienced, and now it's around 24% of their revenue, which is something very nice. Being a subscription-based business model, they have over 82% gross margin. They are now free cash flow positive, and they announced a $200 million stock buyback, which is something nice for the company, especially as the share price went down a lot. But of course, DocuSign doesn't operate by itself in this industry. Now it's the leader, around 60% market shares. Over 6,785 websites actually use DocuSign. Many also, like Amazon, Walmart, even the US government, use a lot of DocuSign's product. But it's not alone. Again, there's this website called Zinc. It's around 25% market share. You have Adobe Sign. I think Adobe is a big competitor, is going to be something big in the future in terms of e-signing, because Adobe is just such an amazing business model. And they also have a lot of other products, like the Photoshop and other things that people already have, and then they can just sell Adobe Sign to them, or the PDF, which they own the rights to, and many other things. So I think Adobe is going to be something big. And then you have Sign Now and other kind of competitors. But again, the competitive space is getting tighter and tighter for DocuSign, and this is kind of a risk or a headwind I would personally point to for DocuSign, especially something from Adobe, which I think they can do much more in the future in terms of taking market share from DocuSign. Now, the second thing with DocuSign, their history, of course, they have been diluting shareholders a lot. You could see the shares outstanding have been going up, but now they actually scaled the business a little bit more. They are free cash flow positive. They announced a share buybacks. So I don't think they're gonna be much more share dilutions in the future. I mean, there could be, but again, I don't really think so. I think it's going to be flat from here, or steadily increasing, with stock-based compensation and other things for their employees. So I don't think it's going to go up much more, but it's something, of course, to watch for. One more thing I want to also point to is the balance sheet. It's not really the best balance sheet in the world. If you look at the current asset and the current liabilities, you could see that the current liabilities are actually higher than the current assets. And as you guys know me, you know that this is something I don't personally like. And also, if you look at the stockholders' equity, it's only 275 million. And the entire market cap is like, how much was it, like 14 or 15 billion? So it's very small. It has been going down year over year, which is again something I don't really like. One more thing I want to, of course, talk about is the valuation. The stock traded as high as 47 times sales, 30 times sales. I mean, people were paying that kind of multiple for the stock because there was so much excitement about the industry. This is how every industry starts, like the cannabis industry, like, I don't know, the tech, I like cryptocurrency, kind of mining stocks. Every time there's a lot of hype, they trade at sky high, and then they come back to earth. And the stock did really come back to earth. Now it says at a price to sales of 9, but the real price to sales is around 7 as I calculated it. And you could maybe argue that even 7 is high in this environment, but it's of course much lower than the mean of 21 or the high of 47 times sales. I mean, this is absolutely crazy. Now, as you guys know, the main reason why the stock went down so much is because of lower growth expectations. This is what I'm going to use in my personal valuation model on DocuSign. You know, between 21 to 27% compound annual growth rate is expected for this industry in general to grow until 2025. But I use a much slower compound annual growth rate. They expect, DocuSign themselves, their guidance is around 15 to 17% growth. So I built on these numbers over the next 5 years to kind of estimate the best kind of the best price multiple for DocuSign to assume what we're gonna buy it for. So this is my valuation model. They make around 2.1 billion right now in revenue. They trade around a 14.8 billion. This is not the right PE here, just don't worry about this one. But the market cap right now is around 14.8 billion. And for my revenue growth, I use 17%, which what they expect themselves for 2022, and then 15%, just straight 15%, which I think is highly achievable with something like DocuSign. Even if there's a lot of competitors, the industry itself is gonna grow 21 to 27%, and they're also expanding internationally, which is an untapped market in terms of the e-signing of documents. So I think 15% is pretty fair. Now, in terms of net income margins, I use a 20% net income margin. This is what they were having lately in terms of net income margin, and this is also what something normally like Adobe, normally like those kind of software as a service business models, they have at least a 20% net income margin. So I used that with DocuSign. I got around 862 million in net income in 2026. For a PE ratio, I use something like 30 PE, which is what Adobe is trading at right now. It's trading at a forward PE of 30, but I used a PE of 30 for DocuSign, which is maybe is a little bit too high, but I think is somewhat pretty fair. I got around a $25.8 billion market cap. The market cap right now is 14.8 billion. This is around a 74% upside only over the next 5 years, or 11.7% compound annual growth rate every single year for the next 5 years. Now, based on my business on my valuation model, I actually think that DocuSign is still not a buy for me, because for me, if it was more around $50, I think this would be a much better price. For example, let's take this 14 billion and let's assume DocuSign was actually trading around 10 billion. If DocuSign was trading around 10 billion, which is much lower than now, it's like a 50, I believe $45 to $50 a share, you would have around 159% upside over the next 5 years. Now, many of you are going to tell me, yes, but this kind of PE is low, it should be trading at a 40 PE or a 50 PE. Well, Facebook, Meta, is trading at a 13 PE. So there's nothing that can prevent DocuSign from trading at a 30 PE or even a 20 PE. But in this case, if you pay a lower price and would just use a 20p instead of 30, you're still making around a 72% upside over the next 5 years. Yes, they may crush those revenue growth numbers, but you want to take the worst case scenario, not the best case scenario in your kind of valuation models, because they may not meet those guidance in the future with inflation, with many kind of competition and uncertainties we may have in the market. So for me, DocuSign is actually not a buy right now. Around the $10 billion market cap or $45 to $50 a share, I think it's a much better buy if you are interested in DocuSign. So I'm personally not buying it, but you watch this video and now you can go and do your own due diligence and make sure of the numbers, and you could see if DocuSign is a buy for you or not. So if you enjoyed this kind of videos, I hope you enjoyed it. If you liked it, please press like and maybe consider subscribing. So I hope to see you in another one.